Hi, I'm Rob Murphy, Head of Financials at Edison Group in London, and I'm delighted today to be invited to speak with Vassilis Psaltis, CEO of ALPHA.AT here in Athens.
Rob, thank you very much. It's excellent having the opportunity to speak.
Fantastic. So let's start with the very basic stuff, as our audience is maybe not that familiar with ALPHA.AT. Who are you and what makes you different?
Well, ALPHA.AT is a universal bank. We are among the 4 systemic banks in the country. In terms of the key figures, we have a balance sheet of about 75 billion in assets. We have 40 billion in loans and a bit more of 50 billion in deposits. We have a tangible equity value a bit more of 6.2 billion, and nowadays our market capitalization is around the 3.6 billion marks. For 2023, the market is expecting us to deliver more than 700 million in terms of profit. As a bank, we have a unique history of 140 years. We are the oldest privately owned Greek bank, and we have been the only listed company in the Athens Stock Exchange, whereby since the Second World War and in the onset of the Greek crisis, we have been able to pay uninterruptedly a dividend. And on top, I would also say that we are the bank that got the least state aid during the crisis. Now, as the trusted relationship bank in Greece, our customers see us as a reliable, resilient and humane partner. We are the leading bank in trusted advice, in expertise and professionalism, and this does get reflected in our market share that we're having, in the customer satisfaction scores, but also in the long tenure of our client relationship. We do consider as our mission to create superior value for our shareholders and empower our customers for growth. And I would say we have a solid track record on this. We are the market leader in wholesale. We are the bank of choice in terms of affluent, and our strong customer relationship and partnerships, this is what fuels our growth. We're fortunate to operate in a good macroeconomic context, and in particular in the current juncture where there is political and economic positive dynamics for Greece. We have also an ambitious plan for the next 3 years, aiming to grow our earnings by 20% per annum, and this should deliver a tangible equity, a return on our tangible equity north of 12% by the year 2025. Throughout this 3-year journey, we're expected to generate shy of 2.3 billion in terms of capital.
That's a very useful background. You mentioned the macroeconomic context, which from the outside looks pretty favourable, as you've indicated. What are your thoughts on the outlook, and how does that affect your plans?
Well, the Greek economy has indeed been remarkably resilient over the very recent years, in the sense that we have been able to accommodate 2 consecutive crises and come out strong. This is on the back of a program of structural reforms, and the ongoing transformation that as a country we're going through has been significantly accelerated by some strong inflow of EU funds that allow Greece to capture the opportunity not just to revitalize the economy, but also to change its productive model towards an investment-led growth model. This has been coupled with quite robust public finances, as evidenced by the decrease by 18 percentage points of debt to GDP ratio, but also improving business and investor confidence. Greece has been, as we have seen lately in ratings, being able to get catapulted by 16 positions in the ranking. That's quite impressive. And alongside all this, I would say we have witnessed the most significant transformation in the banking sector that we can recall in history. Therefore, the significantly improving debt dynamics, the significantly improving investor confidence, as well as also with a strong banking system and political stability, all these factors have contributed towards Greece gaining back the investment grade in 2023. The strong fundamentals drive banking demand also in the market, the improvement in employment, the improvement in disposable income, but also the combination of the two, which has driven savings higher, while the real estate market being resilient. These are all very conducive to the increase of banking demand. Over and above, I would say also that digital awareness is significantly increasing, which allows for digitization of banking services, but also foreign direct investments have been significantly keeping pace. We're talking about since 2019 experiencing an on average 17% growth per annum. On top of that, I would say also that competitiveness is increasing in Greece, and that has allowed for exports to outpacing GDP. So if we are to look at next year, for example, GDP is expected to grow by 2.5 to 3%, and that is definitely faster than the European average, which has been also the case in the preceding years. We do also expect that unemployment will drop towards 10% or even lower, and disposable incomes and house prices grow between 3 and 4%. The growth that we are seeing is driven by these structural trends that affect profoundly the demand for banking services, and there is more pronounced in segments where we are very strongly presented, and this is the area of business banking and the area of investments for individuals. Thus, we do believe that by this uniquely position that we do have, we're going to be able to capture these trends and have a significant improvement in our numbers as well.
So what are your strategic priorities, and how do you position or reposition the organisation to take advantage of the growth opportunities in Greece?
Well, our priorities indeed had to evolve over the recent past. The crisis years were a period of deep restructuring where we focused on restoring our balance sheet, where we wanted to fix the fundamentals of our operating model, and that obviously led to cost rationalization and the normalization of cost of risk. As the shrinking balance sheet impacted our revenues, then our focus turned on top-line growth, which was thankfully supported by a very beneficial macro environment. Now, just imagine, by the end of this year, we will be able to overachieve our targets of a 10% return on tangible equity already. Now, going forward, we aim to deliver a return on tangible equity, which is north of 12% by year 2025, 20% earnings growth, but also 2.3 billion in terms of capital generation over this 3-year period. That should allow us to pay dividends in 2024 on the profits of 2023, obviously after finalizing our dialogue with the regulator. Now, to accomplish all that, we have set ourselves 6 strategic priorities that form practically the operational levers where we are focusing on achieving our financial result, aimed at swiftly improving the structural profitability of each and every business unit. So that means that in retail, we're focusing on ensuring that we're going to be able to digitize the everyday banking services. That should allow for incremental time for our people at the front to look into further commercial opportunities. In the area of wealth, where we want to address a wider customer audience, there the idea is to scale up our wealth engine and customize our investment proposition so that the penetration into investment increases. In wholesale, where we have a leading role, there we aim to capture any opportunity that practically appears in the growing Greek market whilst maintaining our robust profitability. In international business, there the improvement should come by an improving return on the capital that we have deployed. So all along, we are ensuring the resilience of our balance sheet to price prudently our performing loan portfolio, to reduce the problematic assets, but also to maintain strong level of liquidity. And finally, we're using also sustainability as a value creation lever. This plan is enabled by investments that we're doing in both people and digital.
Is everything going to plan so far? And we're all living in a difficult economic times now with inflation and interest rates. Have you felt the need to adjust any of your plans?
Well, we have come out with our plan fairly recently. That was just in June 2023. This is something also that I would urge our esteemed audience also to have a look at. We believe that it was quite an effort to really get the bank out there to people to get to know it. Now, ever since, I would say, as far as the structural trends is concerned, there is not much that has changed, albeit there are some shifts in the more short-term cyclical trends, and practically what we are preparing now is for higher rates for a longer period. Now, clearly for us as a bank that has a strong retail deposit base, we will come to benefit out of that, and that's why we are trying to adjust our balance sheet accordingly. We recently also posted a strong 9-month set of results. Our profitability has been growing by more than 12% with well over $500 million of normalized earnings. Revenues have been growing close to 20% year on year, driven by higher rates, but also higher volumes in terms of bonds, in terms of loans, but also higher recurring fees. Operating leverage and strict cost control has allowed for our cost to income to drop significantly towards the low 40s. Asset quality, as a last point in those results, I would say that it proved that it remains relatively benign, and that meant that our cost of risk is now largely normalized. Now, as a result, we have generated 24 cents per share, which is almost double towards the performance, bottom line performance that we had last year. And if one is to summarize, this improvement comes mostly from two sources. On the one hand, we are seeing a structural improvement in the profitability of every single business unit that we have, as the levers that we're looking towards operationalizing combine nicely with the macro tailwinds, and that gives us this significant improvement and the sustainability in the high returns. And secondly, we ensure that we allocate our capital in a very disciplined and accretive way. With the latest quarter results, we have continued to demonstrate that we are making good work in meeting our financial targets, increasing profitability, generating more capital in order to support both our growth and create value for our shareholders.
That's great. So maybe to switch gears a little bit, you recently announced a deal with UniCredit of Italy. Can you walk us through the main components of the deal and how it fits in with your strategy?
Well, indeed, in the 23rd of October this year, we announced what we feel is a groundbreaking agreement with UniCredit that practically engulfs three distinct components. The first is that we have agreed to merge our subsidiaries in Romania in order to create the third largest bank in the country and the second largest in terms of corporate banking. Out of that deal, Alpha Bank will be able to get 300 million in cash and also retain 9.9% in the combined entity. Secondly, we are forming a commercial partnership in asset management, in bancassurance, and in other banking services. UniCredit, in that vein, will acquire 51% of our bancassurance company in the area of life, and this is called ALPHA.AT. And additionally, we, on the other hand, we're going to be distributing UniCredit's mutual funds. As a final point on this complex, we are agreeing with UniCredit a cross-border referral system for our clients. And thirdly, to underpin the strategic nature of this partnership, UniCredit has bought already 9%, a 9% stake in our bank from the Hellenic Financial Stability Fund, which has been the vehicle through which state aid has come into the bank. That was the last mile for the full privatization of the bank, and we're very happy that this has taken place. Now, if one looks at the various facets of this transaction, they're all fully aligned with our strategic objectives. The transaction, on the one hand, vastly improves the return on capital on the capital that we have employed internationally. The merger will unlock the profitability benefits of having critical scale in a country that definitely needs size in order to operate profitably. And we can retain our presence in a capital efficient way, allowing us to enjoy the uplift in value from the synergies, whilst participating in the favorable growth outlook of the country. The transaction has allowed us to, whilst limiting the risk from the investment that would have required otherwise. So that is an additional benefit that we get. Now, the commercial partnership we have formed with UniCredit is equally important. It is a real differentiator for Alpha Bank, as now with that move, we will cement our stronghold in the corporate landscape, because every single Greek corporate that would want to operate abroad practically would be the first call that they would make, as we want to be able to service them in 13 different countries that UniCredit has a presence. On top of that, through this partnership, we will enrich our product range that we can offer to our affluent customers, whilst also bringing expertise that will de-risk our effort to expand into the emerging affluent class, so one tick underneath. And finally, it makes us part of a pan-European network that improves our negotiating power vis-à-vis our counterparties, and that elevates, obviously, our access to various European geographies, as well as also to leading expertise that the UniCredit Group has. Now, these transactions, they're going to be having a positive financial impact for us compared to the 2025 targets that we have released in our Investor Day in June. Overall, this transaction leaves net earnings intact because on the one hand, we will indeed lose the P&L contribution that we had our Romanian subsidiary, but on the other hand, firstly, we will have our almost 10% participation in a much bigger company that will make almost half of the revenue, and on the other hand, we'll have reduced funding cost, but also we will be able to reinvest these 300 million proceeds that we're having. So we will come square. At the same time, we will be further enhancing our capital ratio. This is because we're going to be deconsolidating the risk-weighted asset of Romania, so that will give us another 100 basis points in terms of capital. So same profit, reduced capital density, that means that our profitability ratios will go up by 50 basis points through that. And I would say also a final point, which is important to consider, is that these estimates do not include the potential upside that we will have from the commercial agreements.
Well, that's a fantastic summary of your very comprehensive plans and outlook of the bank. I'd like to thank Vassilios for speaking with us today.
Well, thank you very much.